Welcome to the PlanStrongerTV market update for Wednesday, February 4th. Let's dive right in, but not just yet on the numbers. I want to caution you about where you get your financial information and to be careful about noise, things that cloud what's going on. And I've got an example that I want to bring in and share with you. So manufacturing is coming into spotlight with the global activity, tariffs, and the dollar, and all of these things. I want to share something I happened to catch in the Wall Street Journal. Across the top of the headline is U.S. manufacturing in retreat. And then you read it, it says factories cut jobs as the president's promised boom from tariffs hasn't occurred. But then the article goes on to explain how, well, it's kind of a mixed story. It's been a long period of outsourcing to other countries, U.S. manufacturing. And ironically, there's actually been an uptick in January of U.S. manufacturing. So what I'm going to encourage you to do so that you don't miss out perhaps on investment and growth opportunities because you're hearing negativity, read below the headlines and look at the data. And so that's part of why we do what we do on this report, is to give you data with some commentary based on real numbers, not based on partisan politics or what people would like you to believe. Okay, there you go. All right, so Robert, welcome.
Good morning, David.
So what we're going to do is we'll do the numbers real quick, and then I've got some things to talk about with international.
Okay.
All right, so let's go right to the numbers. You've got your total returns for 2025. You're of course familiar with that. And then 2026. Again, this is a great opportunity to talk about, there's going to be noise and there's going to be ups and downs in the markets, but where are we year to date, right? So we're looking at a decent start for the year. I mean, again, we're 1 month in and the Dow is up 2.5. So multiply by 12 to get an annual return. And so you look down the rest of the numbers. The standouts are small cap, of course, and foreign stocks. And again, we're going to get to international in just a moment. And bonds relatively flat. So not a bad start. And we're a little spoiled with regard to market pullbacks, corrections. These things are common. We've talked about that on this report often. So we haven't seen a major drop in the market since a year now, Robert, back 2025, about February. So about a year since we've had a significant drop. So, keep that in mind also. Okay, to the topic at hand, Robert, international. So we've seen international stocks outperform. We see it year to date already. We saw it in 2025. So what are you seeing as that story playing out in terms of maybe what's driving it and what are some of the opportunities for investors to make international emerging stocks part of their overall portfolio?
Yeah, David mentioned, we haven't had a major pullback, maybe a year. First thing I thought of is, November we had, I don't know if it's classified as an official pullback, but month of November was a lot of volatility. We saw a lot of red on a lot of days. And then yesterday, the markets were down. NASDAQ down over 2% at one point, but it came back up and still ended in the red, but not as bad. So, I thought today, and as you saw, year-to-date numbers are all in the green, David. So the day-to-day volatility can really suck people in, but you have to take a step back, look at the overall. That kind of smooths out the day-to-day. But I thought today would be a great day to talk about international based on yesterday and the volatility we're experiencing in the U.S. market because look, there are shifts happening in international emerging markets, which I want to touch upon. One thing we've already said is the fiscal shift in Europe, especially Germany, increasing fiscal spending, which means deficit spending, and primarily for the military based on the Russia-Ukraine conflict. Another thing under the radar that's happening, deregulatory shift in terms of Europe's finance and banking sector. They have about 10, 11 major banks, very disconnected. In the United States, we're very spoiled, as I think a term you used a few minutes ago, David, in terms of the amount of financialization and securitization we've done with our products. And even though, there are downsides to that. You have to use those securities wisely, but it really frees up capital. And the Europeans are starting to deregulate that, and that can be huge. Even just sticking with the fiscal story, that has room to run with the defense spending, deficit spending. But then if they continue on this deregulatory shift with their banking industry and financials, that can be huge. If they move on to another paradigm shift with their labor markets, even bigger. In Japan, this is kind of old news, but worth mentioning. They're continuing their corporate cultural shifts and reforms. Chinese stimulus always in the news for China trying to stimulate its economy and domestic demand. And then one thing that a lot of people don't talk about, we talk about AI all the time in reference to the United States and developed economies. But AI in terms of second and third world countries, David. Remember, I know I mentioned a year or two ago how third world countries kind of skipped the ATM. They went straight to mobile banking. Huge shift. They've skipped the experimentations that the first world's already developed. Think about what they can do with AI in terms of their agriculture, industry, manufacturing. So you see all these potential opportunities for growth and expansion in the emerging markets, and in fact also non-U.S. developed. So a lot of opportunities there, and investors need to, based on the 2025 numbers, some years we're not saying it's going to completely outperform the United States every year, but growth is there.
Growth is there, and it's very prudent to have that diversification internationally. Robert talked about different countries, these third world, we've got developed, we've got developing, we've got, some that are still kind of in the incubator, if you will. So there's a lot of opportunity. Now, with opportunity, of course, comes risk, Robert. What are some of the headwinds or risks that an investor might face if they say, all right, that's smart, I should do that. I'm going to put 30% of my stock portfolio or my equity allocation into international. What are some of the risks that they might face?
Well, I think in the developed world, Europe especially, investors or the law might get ahead of itself, and a lot of it being baked into the cake, saying, okay, this is going to happen, but then the European Commission or whatever regulatory bodies they have kind of pull back on reform. That can kind of deflate things a little bit. And then I want to focus on China. We never know if the data coming out of China is accurate or not, but that's especially true now in terms of military purges that Xi Jinping is going through right now. Of course, it's under the guise of cutting out corruption, but he's even cutting people out of the military who were loyal to him. So there's this huge undercurrent there in terms of what he's doing. And then with their economy, I've spoken with a few, fund shop managers who come in, and their management teams are saying, China said that their economy grew 5% last year. That was their target. And God forbid if they say, oh, we didn't reach our target. So of course, hey, we reached 5%, but there are doubts that not only did they even expand, but they perhaps even contracted.
Right.
And if more proof of that comes out, to what extent? Did they contract 1%, 2%? Did they grow only 1% or 2% instead of 5%? So China is a very mixed bag of potential future volatility, at least in the emerging markets and international space.
Well, and I think you highlight a fantastic point, Robert, and that is that when we look at international, where you may have, especially in the developing and the frontier markets and all these, the smaller and smaller and less developed countries, industries, and all of that, we've got to be very mindful of transparency and regulation in a good way, where their markets are regulated. So I think that's something that we've got to keep in mind. And again, where there's opportunity, almost always for growth and return, there's going to be risk. And if you ever think you see or hear about return and the risks are either non-existent or minimal, but with a lot of opportunity and growth, pause, evaluate, and think twice, 3 times, 4 times, because often, or very rarely, I should say, does return show up without a boatload of risk accompanying it.
Absolutely.
All right,
Yeah.
good. Any final thoughts?
Final thoughts. kind of in terms of what investors should be thinking about with international markets. Don't write off the United States, of course, especially the growth sector, even though it's pulling back, coming down to more reasonable valuations. Know the opportunities abroad, but don't chase any single headline. Stay diversified, which was number 3. Have positions in sectors and regions, because just in case any one of them outperform in an extraordinary fashion, like non-U.S. and emerging markets did last year. So.
Yeah, I like that. Read below the headlines. And also, just to echo one more time, international. If you want to be international, great. You want to get emerging markets, great. And in doing that, though, if there are certain areas of the world that you are not comfortable with, you just work around them. And there are a million choices out there for how to invest internationally, that you don't necessarily have to be somewhere where either you don't trust it, you have hesitations, or even it doesn't align with your personal values. And so those are some things to think about. All right, well, very good. We'll continue to monitor. We'll read the paper. We'll do our research. Robert will talk to the investment fund managers that we work with to manage our client portfolios. And we'll come back to share with you to help you continue to plan stronger.